Welcome to Financial Insights in Minutes, your go-to channel for time-saving summaries of the day's top real estate market videos. Is the real estate market spiraling out of control?
Today's videos bring crucial insights on housing market changes, from a burst super bubble to skyrocketing foreclosures and mind-boggling scams.
Discover expert opinions, shocking predictions, and trends you can't afford to miss.
Stick around to the end as we summarize areas of agreement and disagreement among these experts. Don't forget to like and subscribe to stay on top of the latest financial insights.
Sachs Realty warns that the housing market super bubble has burst, spelling trouble for home sellers. Real Estate Mindset uncovers the massive spike in commercial foreclosures across Texas. Ken McElroy exposes the dark side of real estate, with scams ruining people's lives. Jason Walter reports on the alarming 18-month high mortgage delinquency rate. BiggerPockets debate whether to pay off rentals or scale up with new investments. Wright interviews a data sleuth, exposing institutional investors' market maneuvers. Ryan Scribner shows you how to create a website from scratch using AI in 2024. Jason Walter provides an in-depth update on California's housing market by county. Welcome to Sachs Realty. Today's episode promises some real estate revelations. We'll discuss the big news that the housing market's super bubble has burst. Guided by our very own Todd Sachs, we'll unpack the current market trends, explain why home prices are falling, and share some valuable insider tips.
Absolutely. If you're into real estate, this is one episode you won't want to miss. Todd brings some compelling evidence that the days of crazy bidding wars and skyrocketing prices might be over. Buckle up.
So what's the core thesis of Todd's discussion?
Todd argues unequivocally that the housing market's super bubble has burst. Contrary to what optimistic platforms like Zillow are reporting, home prices are actually declining. It's a downhill trend from here for sellers.
Interesting. What are some of the key points Todd makes to support this argument?
First up, Todd refers to real-time market observations. He points out an evident decrease in home prices and a cooler market temperature. Properties aren't flying off the shelves. Many listings are showing multiple price reductions.
That's a stark contrast to what we've been hearing. How does Todd address these differing reports?
Great question. Todd challenges Zillow's more optimistic data, arguing it's misleading. He provides concrete examples from Maryland listings to show that many homes are selling below their original asking prices.
What about broader economic factors? Is there anything else at play here?
Absolutely. Todd discusses broader economic issues like recent cybersecurity problems with CrowdStrike as examples of vulnerabilities that could impact the real estate market. He also notes the rising costs of materials, labor, taxes, and maintenance, which could drive prices down further.
Any notable expert insights?
Yes, insights from figures like Peter Schiff align with Todd's findings. They suggest that the market outlook is sobering, with expected declines in home prices.
So, what does the crystal ball say? Any predictions from Todd?
He predicts further declines in home prices. The combination of economic factors and market dynamics will likely keep prices on a downward trend.
What should buyers and sellers expect?
More inventory means buyers will have more options and more leverage. Although there might be slight dips in interest rates, it won't counteract the increase in supply and decrease in demand.
All right, wrapping it all up, what are the takeaways?
The bubble has burst, making this a critical turning point for both buyers and sellers. Sellers need to temper their expectations, while buyers should be strategic and patient. Todd's message is clear: stay informed, be cautious, and always do your homework.
Welcome to Real Estate Mindset on YouTube. Today's hot topic, the commercial real estate apocalypse. Hang on to your hard hats, folks. This one's a doozy. Eric Nelson is our fearless leader, navigating us through Houston's hotspots of real estate despair.
Absolutely. And Eric delivers a gut punch of reality, showing us how Houston's commercial sector is looking more like a ghost town than a booming metropolis. From stalled skyscrapers to foreclosed hotels and multifamily complexes, he's got it all.
All right, so what's Eric's main message here? What's the big headline?
The core thesis is that commercial real estate is teetering on the brink of disaster with soaring foreclosures, especially in Texas. Eric spotlights this looming collapse with a tour of distressed properties in Houston. And let me tell you, it's not pretty.
Let's start with the Skyscraper in the Museum District. What's going on there?
Eric shows us a $100 million project that's come to a grinding halt. No workers, no progress, just a massive stalled construction site. He sees this as a harbinger of broader market troubles.
And Wyatt, Eric's son, jumps in with some alarming foreclosure stats, right?
Exactly. Wyatt reads stats showing a 129% year-over-year increase in commercial foreclosures in Texas. Nationwide, it's even worse at 170%. It's like the foreclosure faucet has been left on full blast.
So, how are these issues manifesting in Houston?
Eric takes us from a luxury apartment skyscraper that's a financial skeleton to a Hilton hotel in foreclosure and an office building mired in legal messes. Each site is a new chapter in a tragic real estate novel.
What predictions does Eric make about the future of these properties and the market as a whole?
Eric foresees an ongoing surge in foreclosures and a grim 2025. He suggests this domino effect could lead to more job losses and increased tax pressures, and ultimately more bulldozers and cranes tearing down rather than building up.
Wrapping up, what are the big takeaways from Eric's tour of doom?
Eric emphasizes that the fallout from commercial real estate foreclosures isn't just contained to developers. It's going to impact communities at large. His call to action? Be prepared and stay informed, because the winds of change are carrying a lot of dust and debris.
Welcome to the Ken McElroy Show on YouTube. Today, we're shedding light on a rather dark topic: real estate scams that are ruining people's lives. Buckle up, folks.
Absolutely. We're diving into the nitty-gritty of how these scams work, and more importantly, how you can avoid falling into their traps. Ken McElroy, our seasoned real estate guru, is leading the charge.
So, what's the main takeaway from Ken McElroy's video? Why should we be on high alert?
The core thesis here is that real estate scams are costing people millions of dollars. Ken aims to help us be aware and cautious to avoid getting duped.
All right, let's break down those key points Ken discussed, starting with the early red flags. What should we be on the lookout for?
First off, any pressure to act quickly when renting or buying is a huge red flag. Plus, if there's not enough thorough paperwork involved, you better raise an eyebrow.
Got it. Now let's get into the infamous wire fraud scams. What's the scoop there?
These scams often involve almost imperceptible changes in email addresses. Imagine getting an email from Wells Fargo instead of Wells Fargo. Last year alone, real estate wire fraud scams racked up losses of $446 million.
Yikes! And what about short-term rental scams? How are they tricking us?
Oh, these scammers are ruthless. They list non-existent properties or even cancel bookings last minute. 12,000 people fell for it just last year. Stick to platforms like Airbnb and VRBO and don't stray off-site to make payments.
Scary stuff. Now let's move to rental scams.
Rental scams are rampant, often involving people renting out properties they don't even own. Be vigilant, and always verify property ownership.
Noted. Lastly, what's the deal with home inspection scams?
Always get an independent home inspector. Cheap isn't cheerful in this case. Underpay, and you'll likely end up overpaying for repairs they missed.
So what does the future hold? Are these scams going to evolve?
Ken predicts they'll only get more sophisticated. With advancing tech, scammers are becoming craftier, making it critical for everyone to stay vigilant.
Wrapping it all up, what are the big takeaways?
Ken urges everyone to do thorough due diligence. Verify emails, maintain thorough paperwork, and stick to trusted rental platforms. And always get independent inspections and have personal contact with your financial reps.
Hey folks, welcome to the Jason Walter channel. Today, we're diving into an alarmingly high spike in U.S. mortgage delinquencies. Jason Walter breaks it down using a fresh report from IC, formerly Black Knight.
Yep, we're talking about mortgage late payments hitting an 18-month high. But is this just a calendar glitch or something more serious? Let's find out.
So what's the scoop here? What's Jason trying to tell us?
The main thesis is that the surge in mortgage delinquencies is largely a calendar issue. Since June ended on a Sunday, payments made over the weekend weren't processed until July. However, there could be deeper economic factors at play.
Got it. Let's break down those key points. What's happening with delinquency rates?
Delinquency rates jumped by 14.5% in June, hitting 3.49%. This rate hasn't been this high in 18 months. The delay in processing payments due to June ending on a Sunday played a big role.
Interesting. Has this happened before?
Indeed, Jason looked at similar situations like March and December of last year. These months also saw temporary upticks when the month ended on a weekend. So the calendar-driven explanation holds some water.
What about foreclosure rates? How do they fit into this picture?
Foreclosure filings from January to June 2024 were fewer than last year but higher than during the moratorium years of 2021 and 2022. Even with the spike in delinquencies, actual foreclosure rates remain historically low, a 14.9% drop in June foreclosure sales, to be precise.
Time to look into the crystal ball. What does Jason predict?
If this spike is indeed calendar-driven, Jason predicts that delinquency rates should drop in July as those delayed payments get processed.
And what about the overall economic situation?
Even if this specific spike is temporary, Jason is cautious. High inflation and record credit card balances continue to strain consumers. This could lead to ongoing issues for many homeowners.
All wrapped up, what are our big takeaways?
Jason emphasizes the importance of keeping an eye on July's numbers to determine if the June spike was a blip or a warning sign. He'll keep us updated, so be sure to stay tuned.
Hey everyone, welcome back to BiggerPockets. Today's video is bursting with insights about paying off rentals, scaling up your property portfolio, and dipping your toe into the world of flipping houses.
Absolutely. It's a real estate smorgasbord today. David and Rob tackle some burning questions from our community. Whether you're just starting out or looking to take your investments to the next level, you're in for a treat. Let's dive in.
All right, so what's the big picture from today's video? What's the thesis?
We're dissecting the age-old debate. Should you pay off your existing rental properties or scale by investing in new ones? David and Rob provide practical advice on this, especially focusing on the potential of flipping houses in high-cost areas.
First off, flipping houses in pricey markets like the Bay Area. Is it a gold mine or a money pit?
Definitely a challenge. With knowledgeable homeowners and crazy competition, flipping in the Bay Area is not for the faint-hearted. David suggests looking to the Midwest, where opportunities are more accessible and competition less fierce. Not a bad plan, if you ask me.
True that. Next up, we've got Brian, who's debating whether to deleverage or scale up. With a 29% loan-to-value ratio, what's the verdict?
Brian's doing great with his portfolio. The advice is to keep scaling, especially in lower-cost markets. Keeping those expenses low and reinvesting savings prudently is the name of the game.
Moving on to partnerships, Harrison from Milwaukee is in a pickle. How do you split responsibilities when co-owning a duplex with dear old dad?
David lays it out. Setting up a joint bank account for all expenses and income ensures fairness and compliance. It's like a financial dance, making sure everyone's in step and not stepping on any toes.
All right, let's look into our crystal ball. What predictions are David and Rob making?
First, we're expecting more folks moving to the Midwest as costs rise elsewhere, so keep an eye on real estate opportunities there. Second, they're cautioning us about interest rates. Investments that cash flow well now might face challenges if rates go up.
Summing it all up, what's the big takeaway?
Strategic caution is key. Scale smartly, choose the right markets, keep cash flowing, and prepare for long-term growth. It's all about balancing risk with opportunity.
Absolutely. And that's a wrap. If you loved today's insights, found Rob to be hilarious and me to be tolerable, hit the comments on YouTube and let us know your favorite part of the show. Until next time, keep those ducks in the road and cash flowing. See you. Welcome back to Melody Wright's YouTube channel. Today, we're diving into the deep end of the real estate pool with our guest, Ari Watchman, a data-savvy sleuth who's turned the San Antonio housing market upside down.
Absolutely. Melody's kicking off her new series, The Forgotten American, and Ari is here to spoil the plot with some surprising twists about institutional investors in the housing market.
What's the big reveal from Ari Watchman's research?
Here's the scoop. Contrary to popular belief, institutional investors aren't gobbling up homes anymore. Ari's data shows they're actually net sellers. offloading properties faster than you can say housing bubble.
All right, let's break it down. How did Ari get started in real estate?
It all started back in 2012, post-2008 financial crisis. Ari saw a unique opportunity, bought a one-bedroom condo, and saw it double in value within 4 years. Talk about perfect timing.
Nice move. Now he's debunking real estate myths left and right?
Oh, you got that right. One busted myth. Home prices never go down in San Antonio. Well, Ari's data shows a steady decline over the past 2 years. Someone called Mythbusters.
And how does he get all this data?
Ari digs deep using tools like PropWire and public records. He's spotted trends like institutional investors who once hoarded homes, now practically holding yard sales.
So what's cooking in the current market?
San Antonio is a buffet of inventory, the highest ever recorded. And yet, sales are at rock bottom, the lowest since 2016, minus the 2020 hiccup.
Let's peek into Ari's crystal ball. What does he see?
Buckle up. Ari predicts more price reductions and a continual rise in inventory. Builders are already slashing prices and offering buy-downs. The good old supply and demand curve is about to get interesting.
So what's the big takeaway from all this?
Ari's main message: empower yourself with data. Institutional investors are selling, the market's correcting, and it's crucial to do your homework before making home buying decisions. Arm yourself with knowledge, folks. It's a jungle out there.
Welcome to Ryan Scribner's YouTube channel. Today's tech treasure: building a website from scratch, faster than you can say artificial intelligence.
That's right. Ryan shows how AI has revolutionized website creation with Durable, a tool that's so user-friendly your grandma could use it to start her knitting blog. Ready to dive in?
So what's the main takeaway from Ryan's video? What's the magic behind this AI wizardry?
The core thesis is simple. AI makes building a professional website quick and painless. Durable eliminates the steep learning curve and hours of coding, letting anyone create a site in under 30 seconds. It's like a magic wand for website creation.
All right, let's get into those key points, starting with the ease of use. How user-friendly is this really?
Well, picture this. No coding, no design headaches, just a few clicks, and boom, you've got a website. Ryan walks us through it, from choosing your business type to getting AI-driven suggestions for names and designs.
Sounds streamlined. And what about the actual creation process? Is it just as effortless?
Absolutely. Ryan shows how to pick a business type, like a lawn care service in this demo. The AI helps at each step, offering suggestions, autofilling details, and even creating logos and taglines. It's like having your own tech team in a box.
So AI isn't just a buzzword here. How does it spice things up?
AI does the heavy lifting, from generating content to customizing layouts. For example, if you don't like an image or text, just click a button to regenerate it. And the AI can even write blog posts. Talk about a smart assistant.
What about extra bells and whistles? Any standout features?
Loads. Durable isn't just a website builder. It's a full-fledged marketing, CRM, and branding platform. You can manage social media, create ads, send emails, and automate responses to leads. It's like a Swiss Army knife for your online presence.
And what does it cost to get all these goodies?
Starting at just $12 a month, with plans including custom domains, unlimited hosting, and access to millions of stock images. Plus, there's a stellar deal with promo code Ryan3 for 30% off the first 3 months. Pretty sweet, right?
All right, it's crystal ball time. Where does Ryan see this heading?
First, he sees AI-powered tools like Durable becoming essential for anyone needing a website quickly and affordably. Second, as AI tech advances, these tools will only get smarter and more personalized, closing the gap between DIY and professional web development.
So, what's the bottom line here?
Ryan wraps up by emphasizing the simplicity and effectiveness of Durable as a website creation tool. It's the perfect solution for both seasoned business pros and newcomers alike. Say goodbye to complicated web design. AI's got your back.
Welcome to the Jason Walter channel. Today's focus: a late July California housing market update, breaking down the action county by county.
That's right. If you missed part 1 where Jason covered statewide trends, you're in for a treat. This time, it's all about the details within regions and counties.
So what's the overall message Jason wants us to take away from this detailed market analysis?
The core takeaway is that while statewide sales are dipping, prices are holding strong. He provides a comprehensive look at key metrics like sales, prices, inventory, and days on market.
All right, let's get into the juicy bits. What are the statewide trends looking like?
Statewide sales dropped by 2.7% in June, but the median home price is over $900,000, only the third time ever. Homes are selling fast too. The average is just 18 days on the market.
Now, what can you tell us about the regional data? What's happening in SoCal and beyond?
Southern California saw an 11.5% drop in sales with a median price of $875,000. Contrast this with the Central Coast, where prices jumped 88.9% despite a nearly 10% drop in sales. The Central Valley's drop was more modest at 5.5%, and the Bay Area, well, they're seeing just a 1.1% sales dip, but have a median price of $1.4 million.
What about inventory and how it's affecting the market?
Great question. About 47.22% of homes sold above the asking price, down from last year, but still better than pre-2020 levels. Southern California saw active listings surge by nearly 40%, yet sales dropped by 11.5%. Talk about a supply-demand mismatch.
All right, crystal ball time. What predictions does Jason have for the near future?
Jason suggests we might see further sales declines and slight price drops as we move deeper into summer and the fall. Regional variations will be key, with some areas like the Bay Area staying strong, while others like Southern California might adjust more.
And to wrap things up, what are the big takeaways?
Jason concludes that understanding local market trends is crucial. Rising inventory and decreasing sales mean buyers and sellers need to make strategic decisions. California's housing market is diverse and ever-changing.
Let's wrap up with a summary of the insights from today's experts. Todd Sachs declares that the housing superbubble has burst, creating uncertainty for sellers, but opportunities for strategic buyers.
Eric Nelson highlights the rising commercial foreclosures as a sign of broader market instability.
In contrast, Ken McElroy exposes the increasing sophistication of real estate scams hurting investors and tenants alike.
Then we have Jason Walter assuring us that while mortgage delinquencies spiked due to calendar issues, persistent economic strains are a concern.
David Green and Rob Abasolo from BiggerPockets emphasize calculated scaling over deleveraging for real estate growth.
Finally, data sleuth Ari Watchman, interviewed by Melody Wright, reveals that institutional investors are now net sellers of properties, challenging public perceptions.
Stay tuned to Financial Insights in Minutes for more crucial updates and diverse expert opinions on the real estate market. Thanks for watching Financial Insights in Minutes for July 24th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.